Probably my guess would be the last shoe to drop if it drops, if they're unable to find their way out of this liquidity crisis. But in the face of that uncertainty, it is very interesting to see the Bitcoin price, for example, more stable in the last quarter than equities and bonds. Back to equities, just one other note there. If you owned technology, consumer discretionary, or consumer services being FANG-like, the last year was horrendous. Anything in innovation was horrendous. And what I'm going to be elucidating in a moment is how much actually happened on the innovation front last year. It was pretty astonishing, and the market just ignored it completely. Now, there are different reasons for these declines. For consumer services, of course, we have the Facebooks and the Netflix being disrupted. TikTok's a big disruptor. They're also now much more hostage to the cycle. Advertising is one of the first line items cut during a recession. And this is why we think we started in a recession early last year, because advertising fell off a cliff. And that is at least a coincident indicator, if not a leading indicator. So they're being disrupted. Now, in other innovation portfolios, true innovation portfolios, the new innovation, those stocks had a very bad year for a different reason. They're not being disrupted. In fact, they are more often than not the disruptors. They were penalized because they're investing aggressively now. And they are doing so because the opportunities associated with the 5 major innovation platforms around which we have centered our research. So once again, multi-omics sequencing, robotics, energy storage, artificial intelligence, and blockchain technologies, they are ready for prime time. They are taking off, as I'm going to describe to you in a moment. But the winners are going to be those companies that are spending aggressively now, especially because with artificial intelligence, many winners are going to be in winner-take-most categories. So we want that. But when the market is focused on one quarter and wants its profits now and its dividends now, and the algorithms basically decide that anything without high profit margins or anything that disappoints on profit margins because of more investing, algorithms, they make none of these distinctions and they just pummel these sorts of stocks. Truth will win out. This reminds me very much of the late 90s for value investors. In the late 90s, value investors looked like they had 2 left feet, looked like they had gone dumb, stupid. And of course, that was the tech and telecom bubble that ended badly. And they were right, after all. Today, innovation investors look like they have 2 left feet, or that they've lost their brains. But we are more convinced than ever that these innovation platforms are evolving maybe faster than even we expected. And we believe staying away from innovation now is going to be as big a mistake as falling all over other investors to try and up technology weightings in the late 90s. Again, truth wins out. On to commodity prices in terms of price signals. I'd like to focus on a number of commodities. I have the list here, and let me find them. But I'll start with a focus on oil. So oil price, the oil price topped out at 130 in early March of this year, right after Russia invaded Ukraine. It is now down it's down 40%. And more importantly, it's now down on a year-over-year basis, which again, this is what upset the market so much, is that energy prices were soaring, and on a year-over-year basis, we're up 50%. Now we're down, and we're down 40% from the peak. Other commodities, lumber's down 69% year over year. The Baltic Freight Dry Index, which is kind of a measure of supply chain tightness, is down 56%. Copper is down 13% year over year. And we do have a few that are flat to up slightly: gold, silver, and corn. But even they have come down significantly, roughly 20% for corn and silver from their peaks, and gold down more than 10%. So a lot of inflation indicators, real-time indicators, are saying we don't have an inflation problem. The reason I wanted to focus on oil is many people are expecting oil to shoot back up. I see forecasts for 140, 130, going to the last high, because of China and China coming back now that they have stopped the lockdown policy, the Strategic Petroleum Reserve here in the United States needing to be refilled, and OPEC cutting back, wanting to stabilize prices. Well, it's interesting that all of these things are true, and yet the oil price can't get going here. And I do believe inventories are a part of the problem. They're probably brimming. And another thing's going to happen here. I mentioned Uber and Tesla, so the demand shifting towards electric and away from fossil fuels, gas-powered. And that is another reason that used car prices are falling. They're down 14% year over year. And we believe that the residual value of these cars is going to collapse if we're right and the consumer preference shift towards electric, especially by Hertz. So that's a business preference shift, continues. And then the last price signal, Bitcoin. It's been incredibly stable after the FTX related fall off last year. And by many of our metrics, and we will be putting out the Bitcoin monthly early next week, by many of our metrics, there is outright capitulation all over the place. David Puel, who is our on-chain analytics expert, has a lot of capitulation metrics, and I think every one of them is where it has always bottomed before a turn. Now, we do have the digital currency group drama around Genesis. So we're watching that, and that probably, my guess, would be the last shoe to drop if it drops, if they're unable to find their way out of this liquidity crisis. But in the face of that uncertainty, it is very interesting to see the Bitcoin price, for example, more stable in the last quarter than equities and bonds. And I think the other thing to note from bonds, if you adjust bonds for inflation, we have never seen a bigger rout. You have to go back to the 1700s to see a bigger rout than we've just been through. Okay, on to innovation, which is what ARK is all about. And we wanted to share some of the facts and figures having to do with 2022. So not even forward looking. We are looking at last year. And we'll start with crypto then. We did get, throughout the year, incredible turmoil around Luna, Terra, Celsius, 3AC, FTX, and so forth, and a really big black eye. But if you look at what caused the black eye, it was not Bitcoin or Ethereum. Those blockchains didn't skip a beat, didn't miss one transaction. And what we saw were the centralized entities touching crypto, FTX, 3AC, Celsius, other hedge funds, imploding. Why? They're centralized, not transparent, and there's no liquidity in them. Whereas if you look at what happened on Ethereum, the smart contracts, as trouble was looming, smart contract related margin calls, they were satisfied. Boom, boom, boom. No questions asked, no legal haggles. It just worked. And I think that will be the lesson coming out of this. And it is very interesting to note that Sam Bankman-Fried didn't like Bitcoin. And he didn't like it, I may have said this last month, he didn't like it because it's decentralized, fully transparent, and he couldn't control it. He considered himself the master of the crypto universe, which, of course, the market has disabused him and others of. One of the reasons I wanted to feature some things that have happened around innovation last year is because investors aren't taking note. And it is pretty astonishing. If we were in a bull market for growth stocks, innovation portfolios would be soaring on the type of news that I'm about to give you.